Hi, I'm James Robinson, and this is my stock pick of the week. This week's stock is Paccar, symbol PCAR. Before we go any further, I want to invite you to follow me on Twitter. My handle is @RobinsonStocks. On my Twitter page, you're more likely to get real-time information on my trades. Whenever I buy or sell a stock, I post it on Twitter. I don't always make a video, and I especially don't make a video right away. So the best way to get real-time information when I'm doing something is at Twitter. I also will put updates when new videos are posted and news and thoughts on the market and stocks in our portfolio. So feel free to follow me on Twitter. Also, if you could, please subscribe, like, and or comment on this page, on this video. Thank you very much. So I plan on making 5 parts to the video on Paccar. The first one is the overview, that's this section. Next, I'll do operations, then I'll look at the company's debt, we'll look at their dividends, and we'll look at the company's wealth creation. So Paccar Inc. designs, manufactures, and distributes light, medium, and heavy-duty commercial trucks in the United States, Europe, and internationally. While you perhaps have never heard of Paccar, you likely have heard of some of their products and subsidiaries. Kenworth, Peterbilt, DAF, Dynacraft are all companies that are reasonably well known in the shipping and trucking industry. They're large producers. They make, as you'll see, hundreds of thousands of trucks a year. The company operates in 3 segments: trucks, parts, and financial services. The truck segment designs, manufactures, and distributes trucks that are used for the over-the-road, off-highway hauling of commercial and consumer goods. It sells its trucks through a network of independent dealers through the Kenworth, Peterbilt, and DAF nameplates. The parts segment distributes aftermarket parts for the trucks and related commercial vehicles, while the financial services segment conducts full-service leasing operations under the PacLease trade name. It also provides equipment financing and administrative support and services for its franchisees. It has retail, loan, and leasing services for small, medium, and large commercial trucking companies, as well as independent owner-operated and other businesses. It has a truck inventory and financing services to independent dealers. In addition, the segment offers loans and leases directly to customers for the acquisition of trucks and related equipment. So effectively, if you want to buy one of these trucks, which as you can imagine is a large and expensive item, which requires a lot of expertise and understanding of the industry, Paccar is a lender of choice for those kinds of products. The company also manufactures and markets industrial winches under its Braden, Carco, and Gearmatic nameplates. The company was founded in 1905. It's headquartered in Bellevue, Washington, and the firm employs 28,000 full-time employees. As of February 4th, the company's market cap was $25.72 billion. The revenues were $25.6 billion. It had profits of $2.3 billion. It has a PE ratio of 10.82. That's half the PE ratio for the average S&P 500 company. It has a yield of 1.72%. The company has long-term debt of about $7 billion. So as we discuss in every video, I look at companies and I measure them in 29 categories, which I think are the categories which are easiest to determine how well run a company is. It looks at a company in 3 broad segments. One of them is operating. We look at 9 issues in operating categories. Operating is how well the company creates and manufactures and delivers its goods and services to the customer. We look at financial, which is how much debt the company has, how much risk they have, and how efficient they are with their debt. And third, I look at management, which is predominantly the company's ability to create wealth and return wealth to the shareholders. So this company has a total score of 97. That makes it the 41st highest company I've looked at out of 927 companies. So it's an excellent company, and it's even more spectacular when you consider that it's trading at just under 11 times earnings. I always talk about how important gross margins are, and in this situation, the company's gross margins are relatively poor. It's a very large manufacturer of very heavy equipment. But the reason I bring that up is I always say how important that is, but it's just a component. There are lots of components that I look at, and so I'm willing to overlook even a 1 in what I think is the single most important category of gross margins if the rest of the company looks really, really good, which this one does. So why am I telling you to buy Paccar? First, I think it's a very undervalued company. Its overall ranking based on my scoring system is 3.34. That makes it the 41st best company I've looked at out of the 928 companies that I've reviewed. Of those 928 companies, about 170 of them are companies which I consider to be companies that are solid enough that I would consider buying them at the right price. The average PE for those 168 or 170 great companies is 34 today. So when you compare that to a company that's amongst the best of those companies, the top 25% of those great companies, and is trading at 10 times earnings, you see why I'm all of a sudden pretty excited about this company. The firm has a little more debt than I'd like in absolute terms. It has $6 billion in debt, and that's long-term debt. But that doesn't really tell the whole story. The company claims that it has no debt required for its operation and manufacturing. The debt is basically used in the financing component. And the company has $14 billion of assets in that financing component, so in its financial services division. So the debt is there and it's not to be ignored, but I think it's minimal when looked at in context. The company has 10.72 PE ratio. That's half of the average of the S&P 500. And that's despite the fact that last year the company had record revenues, it had record profits, it pays a solid dividend of about 1.8%. For the last 20 years, the dividend has grown by 11% a year, and the company's made significant stock repurchase. So in spite of all of that, the company's trading at 10.72 times earnings. I believe that the management demonstrates an ownership mentality and has over the long term. So I find this company appealing on its merits, but more than that is I really am intrigued by the trucking industry. I think it's an industry that has a lot of upside. And so for a number of reasons, I think that any company that I can find that's a good company in that industry is something we should be considering. I think that the North American free trade industry will be good for trucking. I think that the booming economy is good for trucking. I think that manufacturing jobs coming back to America, or at least not leaving America like they were, is good for the trucking industry. And so I think all of that enhances that when the truckers are doing well, they need more trucks. When they're doing well, they can afford to buy new trucks. I think that electric trucks are coming out, and Paccar is researching to create electric trucks. So another thing that I think about is about $10 billion of the $24 billion in revenue comes from international markets. So when you add all that up, I think you find a very solid company that seems to do intelligent things with its profits, doesn't have a lot of debt, is not too focused on just one industry, and is in an industry that I happen to like a lot. I think you can understand why I'm advising you to consider buying Paccar.